Most people think the credit system rewards them for doing the right thing. They use the card, they pay the bill, they pay on time, they pay in full, they pay zero interest, they never miss a due date. Then a few days later, their phone shows a notification that their credit score dropped 20 points. They become confused because from their point of view, they did everything correctly. And in one sense, they did. But the credit system is not measuring responsibility in the way most people think it is measuring responsibility. It is not watching your bank account in real time. It is not waiting until after you pay the bill. It is not asking whether you have the money. It is not giving you credit for the fact that you paid in full before interest was charged. The system is taking a picture, one picture, on one specific day. And if that picture shows a high balance, your credit report can make you look riskier than you really are. That is the trap. Imagine you have a credit card with a $5,000 limit during the month. You spend $2,000 on groceries, gas subscriptions, travel, and ordinary bills. You have the money sitting in your checking account. You are not broke, you are not reckless, you are not borrowing because you cannot afford your life. The bill comes, you pay the full $2,000, no interest, no late fee, no minimum payment games. You did exactly what most responsible people are told to do. Then your score falls. That is when people usually think something is wrong. They think it must be a glitch. They think it must be identity theft. They think the bank made a mistake. But very often, nothing is broken. The system is doing exactly what it was built to do. It is just not built around the day you think matters. The day most people think matters is the due date. The day that actually controls the reported balance is the statement closing date. That is the whole game if you understand the difference between those two dates. You can start controlling what the credit bureaus see. If you do not understand the difference, the bank controls the picture every month. And you may keep wondering why your score moves even though you pay everything on time. This is one of the clearest examples of how a financial system can punish people who follow the general rule but do not understand the operational rule. The general rule is pay on time that matters tremendously. Payment history is the largest part of the credit score. But the operational rule is different. If you care about utilization, the balance that matters is the balance shown when the statement closes. That balance is the snapshot. That snapshot is sent to Experian, TransUnion, and Equifax. That reported balance can sit on your credit report until the next statement cycle updates it. So if your card shows 40% utilization on the statement closing date, the bureaus may treat you like a person using 40% of that available credit, even if you pay the entire card to zero before the due date. That is why paying by the due date prevents interest and late fees, but it may not prevent a utilization-related score drop. These are two different systems. The payment due date protects you from late payments and interest. The statement closing date controls what balance gets reported. Most people manage the first date and ignore the second. That is why they are surprised. Let us walk through the machine slowly. A credit card has a billing cycle, usually around 30 days. During that billing cycle, you use the card. The balance rises and falls depending on spending and payments. At the end of the cycle, the bank closes the statement. That day is the statement closing date, sometimes called the cycle closing date or billing cycle end date on that day. The bank generates the bill. The balance shown on that bill becomes the statement balance that is usually the number the bank reports to the credit bureaus. Then, after the statement closes, you get a grace period, often around 25 days. The payment due date comes later. If you pay the full statement balance by the due date, you usually pay no interest. That is good, that is responsible, but the credit bureaus may already have received the statement balance before you paid it. So the bureaus may see $2,000 on a $5,000 card. That is 40% utilization, even if you paid it in full later. The report may still show that 40% until the next cycle. This is why people with good habits can still see bad score movement. They are not late. They are not paying interest. They are simply allowing the wrong number to be photographed. That is the mental model. Credit reporting is like a camera. It does not care what your balance looked like yesterday. It does not care what it will look like after you pay tomorrow. It captures the balance on the reporting date. If the room is messy when the camera clicks, the picture is messy. The solution is not to stop using credit. The solution is to clean the room before the camera clicks. Now, why does that picture matter so much? Because utilization is one of the largest components of the credit score. Credit scores are built from multiple categories. Payment history is the biggest. That makes sense because lenders want to know whether you pay what you owe. But right behind payment history is amounts owed, and a major part of that is credit utilization. Utilization is the percentage of available credit you are using. If your card has a $5,000 limit and the reported balance is $2,000, your utilization on that card is 40%. If the reported balance is $100, utilization is 2%. The person may be identical, the spending may be identical, the payment behavior may be identical. The only difference is the day the balance was captured. That is why timing matters so much. The scoring model does not know your intention. It sees a reported balance. And when reported balances are high relative to limits, the model can interpret that as risk. It does not matter that you paid later. It does not matter that you had the cash. It does not matter that you never pay interest. The reported number is the reported number. The dangerous zone often begins when utilization rises above common thresholds. Under 30% is usually considered acceptable. Under 10% is often better. But the people with the strongest scores often keep reported utilization extremely low, sometimes around 1 to 6%. This is where many people misunderstand the system. They think good credit means never being late. That is only part of it. Great credit also means looking low risk at the moment the bureaus receive the data. The difference between good and great can come down to a few days. Now, there is another detail that many people miss. Utilization is not only measured across all your cards combined, it can also matter on each individual card. That means you can have a lot of total available credit and still get hurt by one card reporting high usage. Imagine you have $50,000 of total available credit across several cards. Your total usage is low, but one card has a $600 limit, and you let it report a $580 balance. That single card is almost maxed out. The scoring model may treat that as a warning sign, even if your total usage across all cards is low. This is why single card utilization matters. The system does not only ask, how much of all credit are you using? It can also ask, is any one card being pushed close to the limit? A maxed out card sends a different signal than a card with a tiny reported balance. This is why people sometimes see a 30 or 40-point drop from one month to the next without missing a payment. They put a large purchase on a low-limit card. The statement closed before they paid it down. The bank reported a high utilization number. The score fell. The behavior may have been harmless. The snapshot looked risky. That is the entire problem. Now, here's the good news. Utilization is one of the fastest score factors to correct because in most commonly used scoring models, it has little memory. A late payment can sit on a credit report for years. A collection can damage a file for a long time, but utilization usually resets when the next balance reports. If you let a high balance report this month and your score drops, you can often recover the lost points by reporting a low balance next month that makes utilization different from many credit problems. It is not a permanent scar, it is a monthly signal that is powerful because it means you can influence it quickly. There are newer models such as FICO 10T that pay more attention to trended data and balance history over time. Over the long run, that may make sustained patterns more important, but many lenders still use older models where current reported utilization has a very large short-term effect that creates an opportunity. You can manage the signal not by hiding debt, not by cheating, not by manipulating something illegally. By understanding when the report happens and making sure the number reported reflects your true low-risk behavior. This is the difference between working harder and working with the machine. Most people pay on the due date because that is what the bank highlights. The bank app shows the due date clearly. The email reminds you of the due date. Autopay is built around the due date. But the due date is not the snapshot date. Autopay protects you from being late. It does not control what gets reported. This is one of the most important practical lessons. Autopay is excellent for avoiding late payments, but autopay usually pulls after the statement closes. That means autopay may pay the bill perfectly while still allowing a high statement balance to report. So do not confuse autopay with utilization management. They are different tools. Autopay is a safety net. Manual early payment is the utilization control. Now the strategy is simple. Find the statement closing date, pay the balance down before the statement closes. Leave a small balance if you want the best utilization signal. Let that small balance report. Then pay the remaining balance by the due date. That is the system. Suppose your statement closes on the 15th. On the 11th, your balance is $2,000 on a $5,000 card. If you do nothing, the statement may close with $2,000 and the bank reports 40% utilization. Instead, you log in on the 11th or 12th and make a manual payment of $1,900. Now the balance is $100 when the statement closes on the 15th. The statement shows $100. The bank reports $100. Your utilization is 2%. Then when the due date comes later, you pay the remaining $100, no interest, no late fee, low utilization, the same spending happened, the same full payment happened. The difference is that you controlled the picture. This is not complicated, but it is powerful because the system is mechanical. If the system reports the balance on the statement closing date, then you must manage the balance before the statement closing date. That is the principle. Now, many people make a second mistake after learning this. They think if low utilization is good, zero utilization must be perfect. That sounds logical. But the credit scoring system often rewards a small amount of reported usage more than absolute zero across every card. Why? Because the model is trying to evaluate how you handle credit. If every card reports zero every month, the model may see very little current revolving credit activity. A person who uses credit responsibly and reports a tiny balance can look slightly better than someone who appears not to use revolving credit at all. This is where the 1% rule comes in. The goal is not to carry debt. The goal is to report a tiny balance. Those are different things. Carrying debt means you allow a balance to remain past the due date and may pay interest. Reporting a balance means the statement closes with a small amount that is then paid in full by the due date. You are not paying interest. You are not becoming irresponsible. You are simply allowing the system to see that you use credit lightly and pay it as agreed. The strategy that often works best is sometimes called all zero except one, or ASIO. If you have multiple cards, you pay all cards to zero before their statement closing dates except one. On one card, you leave a tiny balance, often around 1% of that card's limit, or sometimes just $10 to $20, depending on the limit. That one card reports a small balance, all other cards report zero. This sends two messages to the scoring model. You are actively using credit. You are using extremely little of the credit available to you. That combination can be very favorable. It is not necessary for everyone every month. But if you are trying to optimize a score before a mortgage application, auto loan, credit card approval, refinance, apartment application, or other credit event, it can be very useful. The key is to understand the distinction. A small reported balance is not a carried balance. You still pay it off by the due date, no interest, no late fee, no debt trap, just a better reported number. Now, why does this matter so much in real life? Because credit scores affect more than pride. A 20-point or 40-point score movement can influence loan approval, interest rates, insurance costs in some states, apartment applications, credit limits, and access to financial flexibility. If you are applying for a mortgage, a car loan, or a new credit card, the difference between a score tier can cost real money. That means utilization timing can become a financial tool. If you know you will apply for credit soon, you can prepare your reported balances before the lender pulls your score. You do not wait until after the application. You manage the statement cycles in advance. This is how serious people handle the system. They do not merely hope the score is good, they understand what inputs are feeding it. Now let us think about the 5 components of a credit score at a high level. Payment history matters most. Amounts owed, especially utilization, matters heavily. Length of credit history matters. Credit mix matters. New credit inquiries and recently opened accounts matter. You cannot fix all of these quickly. You cannot instantly make a 2-year credit history into a 20-year history. You cannot instantly erase a legitimate late payment. You cannot instantly undo a collection without process. But utilization can move quickly. That is why utilization is so important. It is one of the few major credit factors you can influence this month. The system may be slow in many ways, but this part is responsive. That is the opportunity. Now let us build the step-by-step process first. Find the statement closing date for every credit card you have. Do not use the due date. The due date is not enough. Open your credit card app, go to Statements. Look at a past statement. Find the billing cycle end date, statement closing date, or next closing date. Different banks use different language, but you are looking for the day the statement is generated. Write it down. Do this for every card. This matters because each card can have a different closing date. One may close on the 5th, another on the 15th, another on the 22nd. If you manage only one date, you may still allow another card to report a high balance. Second, set reminders before the closing date, not on the closing date before it. If the card closes on the 15th, set a reminder for the 11th or 12th. Give yourself a few days because payments can take time to post. Weekends and holidays can delay posting. A payment submitted on the 14th of May not reduce the reported balance if it posts after the statement closes. Timing matters. The camera clicks when the statement closes. You need the balance cleaned up before that moment. Third, make a manual payment on the reminder day. Log in, check the current balance, decide what you want reported. If you are using the 1% rule, calculate roughly 1% of the credit limit and leave that amount on one card. Pay everything above that number. If the card limit is $5,000, 1% is $50. If the card limit is $1,000, 1% is $10. You do not need to be perfectly precise. The main point is to report a very low balance, not a high one. Fourth, pay the remaining small statement balance by the due date. This is critical. Do not leave it unpaid. Do not miss the due date because the balance is small. A missed payment on $10 can damage your credit far more than high utilization ever would. Use autopay for the statement balance if it helps. Autopay can be excellent for the due date. Just do not rely on it to manage the reported balance before the statement closes. This gives you two layers. Manual early payment controls utilization. Autopay protects against late payment. That is a strong system. Fifth, avoid credit cycling. Credit cycling happens when you use up your credit limit, pay it down during the month, then use it up again repeatedly, effectively spending far more than your credit limit in one cycle. Banks may see this as suspicious. It can trigger reviews, account freezes, or closures. If you are constantly hitting the limit and paying it down to keep using the card, the better solution may be a credit limit increase, a different card, or lower spending on that card. You want to control reported utilization without creating behavior that alarms the bank. This is important. Optimization should not look like abuse. The goal is to look like a low-risk borrower, not like someone moving too much volume through a low-limit account. Now let us talk about credit limit increases. A higher limit naturally lowers utilization if your spending stays the same. If you spend $1,000 on a card with a $2,000 limit, that is 50% utilization. If the limit becomes $10,000 and you still spend $1,000, utilization is 10%. The spending did not change. The ratio changed. That is why requesting higher limits can help. But be careful. Some banks may do a hard inquiry, others may not. Some may approve automatically, some may ask about income. If you have a good payment history and pay in full, you may have a reasonable case. But a higher limit is only helpful if it does not tempt you to spend more. More available credit is a tool, not an invitation. If a higher limit makes you feel richer and increases your spending, you made the system worse. The point is to reduce utilization, not increase debt. Now, let us talk about low-limit cards. Low-limit cards are often the most dangerous for utilization because ordinary purchases can create high percentages. A $300 grocery bill on a $500 card reports 60% utilization. That can hurt the score even though the dollar amount is small. This is why card-specific utilization matters. If you have a low-limit card, be extra careful not to let it report high balances. Either use it lightly, pay it before closing, or request a limit increase if appropriate. A small card can create a large score movement. The algorithm sees percentages. It does not care that $300 is not a large balance in your real financial life. It sees 60%. That is the machine. Now let us discuss the psychological side. Credit is a system that rewards people who understand dates and ratios. That feels unfair because a person who pays in full after the statement closes may be just as responsible as a person who pays before the statement closes. But the model does not see intention. It sees reported data. This is why anger is less useful than understanding. You can complain that the system should work differently. Maybe it should. But while the system works this way, the intelligent move is to adapt. You are not cheating. You are not lying. You are making sure the reported data accurately shows that you are low risk if you can pay the card down before the statement closes. Then reporting a low balance is not false. It reflects your ability to manage the debt. You are simply choosing the timing. And in finance, timing often changes the outcome. Now, let us talk about the difference between credit score optimization and financial health. A high credit score is useful, but it is not the same as wealth. A person can have an 830 score and no net worth. A person can have millions of dollars and not care much about credit. Credit score is a tool for accessing debt and favorable terms. It should be used intelligently, not worshipped. You should not spend money to build credit. You should not carry interest to build credit. You should not buy things you do not need to make a score move. You should not become obsessed with daily score changes. The goal is not to serve the score. The goal is to make the score serve your financial life. If a higher score lowers your mortgage rate, improves approval odds, or gives flexibility, it is valuable. But the underlying financial behavior matters more. Pay on time, avoid high-interest debt, keep spending controlled, build assets, maintain liquidity, use credit as a tool. The utilization strategy is not a substitute for financial discipline. It is an optimization layered on top of discipline. That is the right framing. Now, what about people whose scores are already high? If your score is already 780 or higher, small utilization changes may still move it, but the practical benefit may be limited unless you are applying for credit. There is a point where the score is good enough for most lending tiers. Chasing every last point can become unnecessary stress. However, before a major loan application, it can still make sense to optimize. You want the cleanest possible profile when the lender pulls. That means low utilization, no late payments, no unnecessary new accounts, no avoidable hard inquiries, and no errors. Before applying for a mortgage, you might manage utilization for 1 or 2 cycles in advance. Let the bureaus receive low balances, then apply. This is preparation, not obsession. Now, what about people with scores in the 500s or 600s? Utilization can help, but it may not solve everything. If there are late payments, charge-offs, collections, high balances, thin credit history, too many inquiries, or errors, the score may stay low even after utilization improves. In that case, you need a broader credit repair and rebuilding plan. Start with credit reports from all 3 bureaus. Look for errors. Look for accounts that are not yours. Look for outdated negative items. Look for duplicate collections. Look for incorrect balances. Look for wrong dates. Look for charge-offs reporting incorrectly. Look for late payments that are inaccurate. Dispute legitimate errors through the proper channels. Pay current obligations on time. Bring accounts current if possible. Reduce utilization. Avoid unnecessary new debt. Build positive history if needed. Use a secured card or credit builder product responsibly. The utilization strategy is powerful, but it is one piece. Do not expect one lever to solve a broken system if the file has multiple problems. This is why diagnosis matters. In any system, you identify the binding constraint. If the binding constraint is utilization, fix utilization. If the binding constraint is late payments, focus on payment history. If the binding constraint is collections, address those. If the binding constraint is thin file, build history. If the binding constraint is errors, correct them. A good plan starts with the right problem. Now let us talk about errors. Credit reports are not perfect. They can contain accounts that do not belong to you, balances that are wrong, old negative items, duplicate entries, or incorrect personal information. These errors can damage your score and your borrowing ability. They do not usually fix themselves. You must check. Do not wait until a mortgage application to discover a problem. Review your reports before you need credit if there is an error. Dispute it with the bureau reporting it, provide documentation, keep records, follow up, understand your rights. Do not assume the system will correct itself because it should. Financial systems reward people who verify. Trust without verification is expensive. Now let us return to the main credit utilization strategy and make it practical. Suppose you have 3 cards. Card A closes on the 10th with a $10,000 limit. Card B closes on the 18th with a $5,000 limit. Card C closes on the 25th with a $2,000 limit. If you want to use the all zero except one method, you might pay card A to 0 before the 10th, pay card B to a tiny balance before the 18th, and pay card C to 0 before the 25th. Then after each statement closes, you pay any remaining balance by the due date. The result is that only one card reports a small balance. All other cards report 0. Overall utilization stays very low. Individual card utilization stays very low. The scoring model sees active, controlled use. That is the cleanest signal. If you only have one card, you can simply let that card report a tiny balance and pay it by the due date. Do not report 0 every month if you are trying to optimize. But do not carry a balance beyond the due date. Again, reported balance is not carried debt. This distinction must be internalized. Now, let us talk about closing dates changing. Some issuers may change a statement closing date if you ask. Some allow due date changes, which may shift the closing date. If your closing dates are inconvenient, you may be able to align them with your paycheck schedule. This can make management easier, but do not overcomplicate it. The basic system is enough for most people. Know the date. Pay before it. Leave one small balance if optimizing. Pay by due date. Repeat. The complexity is not in the rule. The complexity is in remembering it every month. That is why reminders matter. A system you remember beats a strategy you forget. Now, let us talk about the danger of missed payments. Payment history is still the largest category. A single missed payment can damage a score for a long time. That is why autopay remains important. If you are manually paying early, still keep autopay active for at least the minimum payment or statement balance as a backup. Some people become so focused on optimizing utilization that they turn off autopay and forget the due date. That is a serious mistake. Never sacrifice payment history to optimize utilization. The hierarchy is clear. Pay on time first, manage utilization second. Everything else comes after. A perfect utilization strategy with one missed payment is a bad strategy. Now, let us discuss the difference between current balance and statement balance. Your current balance is what you owe at this moment. Your statement balance is the balance captured when the statement closed. The amount due is usually based on the statement balance, not necessarily the current balance. If you make new purchases after the statement closes, they may not be due until the next cycle. That can confuse people. They see a current balance higher than the statement balance, they pay the statement balance by the due date, and avoid interest on the prior cycle. But the new purchases may appear on the next statement. For utilization, the balance reported is usually the statement balance, so the focus is the current balance before the statement closes. You want the current balance low on the closing date. That becomes the statement balance that gets reported. This is the chain. Current balance before closing becomes statement balance. Statement balance gets reported. Reported balance affects utilization. Utilization affects score. Once you see the chain, the action becomes obvious. Now, let us talk about authorized users. If you are an authorized user on someone else's card, that card's utilization may affect your credit report. If the primary cardholder lets a high balance report, your score may be affected even if you did not spend the money. This can be good or bad depending on the card's history and utilization. If an authorized user card is hurting you because utilization is high or payment history is poor, you may need to remove yourself from that account. Again, credit reports are data systems. The system does not always care who created the balance. It cares what account is reporting on your file. Review all accounts. Now, let us talk about business cards. Some business credit cards do not report to personal credit bureaus unless there is a default depending on issuer and product. This matters because business spending can create high balances. If the card reports to personal credit, a large business expense can hurt utilization. If it does not, it may not affect personal utilization. In the same way, know your issuer's reporting policy. Do not assume. If you put large expenses on a card that reports personally, manage the statement balance carefully. This is especially important for entrepreneurs. Now, let us talk about charge cards. Some charge cards do not have a traditional preset spending limit, and utilization may be treated differently, but balances can still matter in underwriting, and some models may interpret reported balances differently. Do not assume a charge card is irrelevant to credit. Understand how it reports. Again, the principle is verification. Now, let us discuss utilization at loan application time. When applying for a mortgage, lenders may pull credit at the beginning and sometimes again before closing. You do not want to let high balances report during that period. You also do not want to open new credit, make large purchases, or change your debt profile without talking to the lender. Credit optimization before and during mortgage underwriting is critical. The statement closing date strategy can help you present low utilization, but do not create unusual activity that concerns the lender. Keep things clean, predictable, and documented before major lending events. Conservative behavior wins. Now, what if you pay before the statement closes, but the bank still reports a different date? Some issuers may report on the statement closing date, but not all behavior is identical. Some report at month end, some may report when the account balance changes in certain cases, some may update after a payment if requested. The statement closing date is the common mechanism. But you should verify with your issuer and by checking your credit reports. After you use the strategy, monitor what actually reports. If the reported balance matches the statement balance, you know the system. If it does not, adjust. This is how to think like a systems person. Observe, act, measure. Adjust. Do not rely only on general advice. Confirm your actual accounts. Now, let us talk about credit score apps. Many apps provide educational scores, often based on VantageScore or a specific bureau. Lenders may use FICO versions that differ. Your score in one app may not match what a mortgage lender sees. This can be confusing. Do not obsess over one app score. Use it for trends. For major lending, understand what score model the lender uses if possible. The utilization strategy still matters because utilization affects most major scoring models, but exact point movements can differ. Again, the score you see may not be the score a lender uses. Do not be surprised. Now let us talk about the deeper lesson. The credit system is not personal. It is a model. A model receives inputs. A model produces a score. If you do not understand the inputs, the output feels unfair. If you understand the inputs, the output becomes more controllable. That is not only true in credit, it is true in investing, taxes, retirement, insurance, and business. Systems reward the people who understand how the measurement works. They penalize people who only understand the slogan. The slogan is pay your bills on time. The measurement is more detailed. Pay on time, keep utilization low, maintain long history, avoid unnecessary new credit. Keep a healthy mix, correct errors. The slogan is not wrong, it is incomplete. That is often how financial education fails people. It gives them the general rule but not the operational rule. The general rule keeps them from disaster. The operational rule helps them optimize. Pay on time keeps you from major damage. Pay before statement. Closing helps you manage utilization. Both are needed. Now let us build a simple monthly routine at the beginning of the month. Know which cards will close and when. 1 week before each closing date. Check the balance 2 to 4 days before closing. Make the manual payment. Leave a small balance on one card if optimizing. Let the statement close. Check the statement balance. Use autopay or manual payment to pay the remaining statement balance by the due date. Once per month, check credit reports or monitoring tools to confirm low balances reported. Once every few months, review credit limits and consider whether a limit increase makes sense. Once per year, pull full credit reports and check for errors. This routine is not difficult, but it requires discipline. The reward is control. Now, let us talk about people who use cards for rewards. Credit card rewards can be useful, but never let points make you report high utilization before a credit event. If you are chasing 2% cashback, but a high reported balance lowers your score and costs you a higher mortgage rate, the rewards were not worth it. Rewards are small. Credit pricing can be large. Do not optimize pennies and lose dollars. If you use cards heavily for rewards, pay them down before closing. That allows you to keep rewards without letting high balances report. Again, timing solves the problem. Now, let us talk about people afraid to use credit cards. Some people see score drops and become afraid to use cards at all. That is not necessary. The card is not the problem. The reporting timing is the problem. If you manage the closing date, you can use the card, pay no interest, earn rewards if appropriate, and still report low utilization. Credit cards are dangerous when they become debt. They are useful when they become payment tools managed with discipline. The same tool can help or hurt depending on behavior. Now, what if you cannot pay down the balance before the statement closes because you do not have the cash? Then the credit score is not the main issue. The main issue is debt and cash flow. Utilization optimization assumes you can pay the card down. If you are carrying balances because you do not have the money, the priority is not gaming the snapshot. The priority is reducing debt, increasing income, cutting spending, and stopping high-interest compounding. Do not use credit score strategy to avoid the deeper problem. A high utilization score drop may be the symptom. The disease may be financial strain. Treat the disease. Now, let us discuss the 1% rule carefully. The 1% rule is not a law. It is a practical optimization. Reporting 1% utilization may produce excellent results for many people, but you do not need to be perfect. Reporting 2% or 3% may also be fine. The main objective is to avoid high reported balances and avoid all cards reporting zero if you are trying to maximize. Do not let precision become stress. A person who reports 2% instead of 1% is not failing. The danger is 40%, 60%, 90%, or maxed out balances reporting. The system rewards low. It does not require obsession. Now, what about total utilization versus individual utilization? Manage both. Overall utilization should be low. Each individual card should also be low. This means do not let one card report high even if your total available credit is large. If you have to make a large purchase, either use a card with a high enough limit that utilization stays low, pay it before the statement closes, or split the purchase if appropriate and not harmful. The main point is to avoid a single card looking maxed out. A low-limit card can hurt disproportionately. Know your limits. Now, let us talk about statement balance timing with multiple purchases. If you pay down the card before closing and then make another purchase before the closing date, that new purchase can raise the reported balance. So after the manual payment, be careful with additional spending until the statement closes. If you need to use the card, check whether the purchase posts before closing. Pending transactions may post later, but do not rely on timing blindly. If you are optimizing before a major application, keep spending simple. Use debit, cash, or a different card after paying down the target card if necessary. The goal is clean reporting. Now let us talk about why banks do not emphasize this. Banks emphasize due dates because due dates protect them from late payments and generate interest if you carry debt. The statement closing date is available but often less visible. That does not mean the bank is conspiring against you. It means the bank's interface is designed around payment collection, not credit optimization. The system tells you what it needs from you. It does not always tell you how to maximize your advantage. That is your job. In personal finance, you must understand incentives. The bank wants payment, the credit bureau wants data, the scoring model wants risk signals, the lender wants a risk ranking, you want access to good terms. These goals overlap but are not identical. Once you see the incentives, the confusion fades. Now, let us talk about control. Credit scores can feel mysterious because the algorithm is not fully transparent, but many inputs are knowable. You can control payment timing, you can control utilization, you can control new applications, you can control whether you check reports, you can control whether you dispute errors, you can control whether you carry high-interest debt. You cannot control everything, but you can control enough to improve outcomes. That is the practical mindset. Do not become a victim of the model. Learn the model. Now let us close with the exact sequence again. Find the statement closing date for each card. Set a reminder 2 to 4 days before that date. Pay the balance down manually before the statement closes. For best optimization, let only one card report a tiny balance, around 1% or a small amount like $10 or $20. Let all other cards report zero. After the statement closes, pay the remaining balance by the due date. Keep autopay as a safety net. Avoid credit cycling. Request higher limits. If your spending regularly creates high utilization and you can handle more available credit responsibly. Monitor your reports, fix errors. Repeat monthly. That is the complete system. Now, I want to end with the most important point. The credit system is not judging your character. It is judging the data it receives. If the bank reports a high balance, the model sees high usage. If the bank reports a low balance, the model sees low usage. The same person can look risky or disciplined depending on the day the picture is taken. That is why the statement closing date matters more than most people realize. Paying on time keeps you safe. Paying before the statement closes makes you look safe. There is a difference. If you understand that difference, you can stop being surprised when your score moves. You can stop fearing normal card usage. You can stop letting the bank choose the worst possible snapshot. You can control what the bureaus see. And in a system where a few points can change interest rates, approvals, and financial options, that control matters. Do not carry debt to build credit. Do not pay interest to build credit. Do not max out cards and hope payment history saves you. Do not rely only on autopay. Do not confuse the due date with the closing date. Use the card, pay it early. Report a tiny balance, pay the rest on time. Keep the system clean. That is how responsible credit use becomes visible to the scoring model. And once you understand the machine, the loophole is not really a loophole at all. It is simply using the rules exactly as they are written instead of living under the illusion that paying the bill after the statement closes is the same as controlling what gets reported. The people with great credit are not always more responsible than everyone else. They often just understand the snapshot. And once you understand the snapshot, you can make the system show the truth. You are not a risky borrower. You just need the picture to be taken after you have cleaned up the balance.